afternoon, everyone. I think we met a couple of you already, but my name is Chase Horton, and this is Matt Imperiolo. We work at Cerulli Associates. For those of you who are not aware, Cerulli Associates is a third-party market research and consulting firm that works specifically with financial services companies in the wealth management and asset management industries. Matt and I specifically work in our wealth management research area, specifically contributing to the high net worth and private bank and trust research areas and companies. And today we'll be going through some of our most recent findings over the last 12 months in the high net worth markets area. So we'll be looking at, throughout the presentation, we'll be looking at household demographics, changes in household demographics, and how that's trickled down and affected different other competitive dynamics in the wealth management and asset management industries. We'll talk about competitive dynamics among intermediaries and wealth management firms, specifically as they look to grow and target high net worth investors. And finally, we'll go through some different services and product trends that we see as the most impactful for firms and firms across the industry. So we like to start off with this exhibit here. I don't know what color it is on the virtual one. In this room, it's a dark blue, but it's the top bar here essentially is what we're going to be focusing on today. But what we're looking at here is the breakdown of investable asset share among households in the United States from 2010 to 2023. And right off the bat, one of the most significant trends that we've seen and something that's going to drive a lot of the conversation today is the growth in the high net worth investor wallet share, market share, and the share of investable assets in the US that are controlled by high net worth investors. So if you look back at 2010, households with 5 million or more in investable assets, which is who Cerulli defines as high net worth. We'll also throw around the term ultra high net worth, but we consider that to be 20 million plus in investable assets. You'll see in 2010, these households controlled 27% of investable assets in the US, but over the years, through this triennial data that we get from the Fed and the census, you can see that as of year-end 2023, we're modeling that these households will now control over 50% of investable assets in the US. This isn't just for definitional purposes. This isn't all wealth in the US. These are investable assets. We'll also use that term interchangeably with financial assets or addressable assets. So these are banking assets, managed assets, investment accounts, and other more financialized assets. Basically, we're just stripping out, homes, primary residences, small family businesses, cars, other things that your firms most likely will not be having a direct hand in managing. Yes.
You guys called it 2 to 5 million. Is that, or how?
We call that affluent. Affluent. Mass affluent, we usually refer to as 500 to 2 million.
Any sense of why the affluent has kind of remained pretty constant there?
It's really, we've just seen a significant amount of wealth basically be accumulated by those wealthy households, and essentially over the years that wealth just keeps moving up and essentially passing through. So they do still control a decent amount in that mass affluent space, and where we really see it trickling down is this lower level, more mass market, where you see it go down from 17% down to 9%. So when you see that growth, it's just going straight to the top. So of course, welcome. But to get slightly more definitional for you, if we go to the next slide, we can drill down a little more into these demographics. You can see here Cerulli's wealth demographic tiers and some of the growth figures that surround those tiers. And if you look from the bottom up, we have mass market, middle market, mass affluent, and then from the wealth market up is what we're going to be talking a lot about today, are those investors with 5 million plus in those investable assets. From a number of household perspective, essentially we're talking about just shy of 3 million households, which is about the top 2% of households in the US. And some of the most significant data we see here is in the last two columns. So the total financial assets, the second column to the left. You'll see that's kind of what we were looking at in the previous slide, where in total, as of 2023, US households held $78 trillion in investable assets. Of that 78, high net worth households held or controlled 40 trillion. So that's where we get that 51% figure. And you can see that broken down. Obviously, a significant amount of wealth and the highest amount of wealth are held by those ultra high net worth clients that we see. with 17 trillion in investable assets as of year-end 2023. And something that we've looked a little bit deeper into is the financial assets added since 2011. So that substantial level of growth coming out of the great financial crisis. We've seen just an insane amount of asset accumulation go straight into that high net worth, ultra high net worth space. And even though, obviously it's significant that they control 51% of investable assets today, over the 12 to 13 year period since 2011, 2 out of every 3 new investable assets and $2 out of $3 have gone into that high net worth demographic. So you can see the total there, it's 51. I believe it's around, if you sum it up, it's around $33 trillion of new investable assets have gone into the high net worth space, in the high net worth retail space since 2011. So it's been a significant amount of growth. It's been really an engine that has driven the competitive dynamics in the wealth management space. We see a lot of firms, their success be defined by how they can target and serve and earn assets and market share in this space. And we'll get into some of those dynamics in a little bit. But that's where we like to start out, is sort of set the picture for what's happened among wealth demographics over the last 10 to 20 years. But as we dive a little deeper into our research at Cerulli, another trend that we like to look at in wealth demographics sort of shifts the perspective forward to wealth transfer. And so I'm sure a lot of you have seen these numbers out there. Cerulli kind of leads the way in projecting these figures in terms of wealth transferring between households into charities and inheritors, projecting that out 25 years. In our most recent exercise in 2021, we modeled that $84 trillion would be transferred to heirs and charities over the 25-year period looking forward. And 73 trillion of that we expect to go to Gen X and millennial households. Just as a clarifier here, we're talking about wealth, so that's why these numbers may seem a little bit bigger, substantially bigger than the numbers we were talking about on the other screen, the previous slide. So this is wealth, so this does include those non-financial assets as well. So this includes all real estate investments, and things like second houses, boats, planes, and things like that. But ultimately what we see here is that, a significant amount of this wealth will be transferred over the next 25 years to Gen X and millennial households. And it's a significant trend that's on the mind of both wealth holders right now, inheritors, as well as the wealth managers, investment managers that are going to be in charge of making sure that these transfers are as efficient and amicable as possible. And so one more slide we want to go through just before we get into some of the channel dynamics is just to get a little bit of a snapshot into the mindset of these investors. So we've sort of talked about them. They're obviously very wealthy. They're also generally tend to be older. The average age is I want to say up in the 60s for a high net worth investor household. And if we look at this slide, we see their most important investment objective. So the top 3 here is really what I want to focus on. It's what really, when they come to a wealth manager or an investment manager, this is what they're interested in after and what they care about. So the first one is wealth preservation. This leads the way in the data. Basically, every single year after year, is the top priority and the top investment objective among high net worth households. A lot of these households are on the older side, like I said, so they have a slightly shorter time horizon, and they're interested in preserving their wealth. They're also usually tend to be independently wealthy, and so they've made their money in ways typically outside of the stock market or other investments. So they've sold those, whether that be businesses or they've saved up. They've sold those things and want to preserve that wealth for the remainder of their lives in general, to make a general statement about the population. If we look down the line, tax minimization is an incredibly common conversation point for these investors. I don't think there's any other investor or any other demographic that thinks more about taxes than high net worth households, particularly the older high net worth households. And so they often go to their advisors and their lawyers and estate planners looking for ways to minimize taxes. We've seen a lot of the different service trends around the high net worth practice space be built around tax minimization, whether it's clever ways of tax loss harvesting, different clever estate planning strategies have also gained popularity to, some other use of LLCs and other domaining problems. And finally, what I've already mentioned, wealth transfer strategies. A lot of the service or the service trends that we'll talk about in a little bit are being driven by massive amount of wealth transfer, the wealth that's going to be transferred in the coming decades. And so, yeah, it's just top of mind. And a lot of those three strategies make up 90+% of the conversations of most impact that we see in our anecdotal conversations with wealth managers in the space. Any questions on anything we discussed so far? Great. And I'll hand it off to Matt, and he'll walk through some of the channel insights and different competitive dynamics in the intermediaries that manage these assets.
Yeah, feel free to cut me off at any time with questions. Like the conversation go back and forth with you guys, and just go off the slides. So feel free to just cut me off at any point. But so this is a really good place to start in terms of kind of industry-wide competitive dynamics, kind of who's winning and why for these high net worth assets. So in terms of housekeeping, what we're looking at here is the size of the bubble, is the total assets under management within each of these intermediary channels for high net worth investors specifically. So again, that's 5 million plus investable assets. And the positioning on the horizontal axis is their 5-year annualized growth rate. The vertical positioning is just so we can fit everything on the same slide. It's irrelevant really to the data. So just from a definitional perspective, I guess I'll just work from left to right. I think that makes the most sense. Talking about each channel and then kind of the sort of benefits and the headwinds in the face of that specific practice type. So on the left, we have the bank trusts. That is just the banks that you're all familiar with, the bank you would see kind of a brick and mortar location, generally with a bit more focus towards retail and mass affluent markets, but with some capabilities able to serve high net worth investors as well. And we break that down into 3 subsegments, which are the super regionals, which is like your PNC, US Trust, Citizens, Key Bank, big name banks that are kind of all across the country. Then we have regionals, which are kind of exactly what it sounds, a little more regional, maybe 2 or 3 states, like maybe serve the New England region or something like that. That would be like a Webster Bank or something like that. And then community banks we also size as part of this exercise, which are generally one state and serve exactly what it sounds like, a community. So think like Rockland Trust as a local one that would fall into that category. And so they're on the smaller side in terms of high net worth assets, largely due to kind of the nature of how they source their business. It's largely referrals from bankers over to the wealth management business or the trust company. And there's just not a huge amount of opportunity for $5 million plus clients in that operating model. However, we do feel optimistic about the bank sector. Over the last 5 or 10 years or so, they've really been a big push to increase deposits. It's really their core business. And once they are a little more serious about translating those deposit dollars into wealth management dollars through active referral activity, I think we'll see some growth in that space. And then the wirehouses, those are the obvious ones. That's Morgan, Merrill, UBS, and Wells. They're by far the biggest player, really, no matter how you look at the industry. But especially for high net worth, that's almost $5 trillion in assets that'll go up when we size the market for 2023, which is worth mentioning. These are 2022 year-end figures. So this is following a down market, obviously. Preliminary numbers in some of these channels, we're seeing around high single digit to, in some cases, nearly 20% growth over the last year. And that's not high net worth specific, but you can expect the growth rates for high net worth specifically to kind of follow that trend, if not outpace it slightly due to some of the wealth concentration that Chase mentioned. And wirehouses obviously benefit from really skilled advisors, historical focus on high net worth investors, huge scale, global brand presence, and basically the ability to serve any type of client need that could arise. There's really nothing that a wirehouse won't do. And the same goes for the private banks. I would kind of define them in a very similar way. That's JP Morgan, Goldman Sachs, Bessemer. Those guys, there's about 15 of them that we include as private banks in our sizings. Very similar to a wirehouse, really, the way that they look and feel, especially Goldman and JP Morgan, Citi, really kind of fall into a very similar bucket. How we kind of define a private bank is a bank whose primary business is not deposit taking and checking, savings, retail lending. They often have investment banking units, commercial banking, and those are really big sources of referrals of high net worth clients. Somebody maybe sells out a large stake of a privately held company, they go public, they now have a large influx of cash they manage, and they're often able to push them over to private bank advisors. Then we have the direct channel, which is an interesting one. It's not one that we cover a ton because we don't think of it as a super high touch, high net worth channel, but they do, as you can see, control a decent portion of assets in the channel. In large part, I think the growth there is due to kind of the last 10 to 15 years of what they call the democratization of investing, with the kind of Robinhood model of no fees and people becoming more educated on sort of self-directed investing. It's become a lot more popular recently. And for that reason, we've seen kind of growth in that channel across the board. Then we go into broker dealers, which is like your Ray J, LPL, Cetera, those kind of operating structures, as well as the insurance VDs and some of the hybrid broker dealer RIA platforms will fall into that hybrid RIA bucket on the far right. And then we have our MFOs, that stands for multifamily office. So that's ACO, Moneta. They are like the most historically high net worth focused, I would say. Big teams, really high touch service models. They'll basically, it's like a really white glove service. So pretty much offer anything that a client may need. My background is working in the family office space at ACO, which is the RIA affiliate of Goldman Sachs. And then the two fastest growing channels by far, which have been for the last several years, are the RIAs. So the independents are strictly independent employee affiliation model, so not W-2 employees essentially. And then the hybrid RIAs, which have affiliated broker dealers. So the reason that those two have grown at really an outpaced rate of the rest of the industry is simple. It goes down to advisor movement. Advisors are attracted to independent service models and a little bit less compliance regulation. And the advisors that are moving into those channels tend to be really entrepreneurial, people who want to build a business and are good at what they do, good at the sales portion of the business. So that's why we see really, fast growth in those channels. Any question on those a lot? Any question on this slide before I move on? I'll keep this one short and sweet. This is just this is like a productivity exercise that we do for each of the channels where we show this is total high net worth assets within the channel over the number of advisors that are high net worth focused within that channel. So the bar is the number of the advisors. The dots are kind of the average practice size that we estimate for advisors in that channel, and the dashed line is the industry average. Unsurprisingly, wires and private banks kind of lead the way in terms of productivity due to what we were talking about on the last slide with kind of their scale, investments in technology, and the fact that they're bringing in a lot of ultra high net worth clients, which is kind of baked in productivity when you're, $100 million, $200 million clients with one advisor. I would say the only surprise here is multifamily office channel falling below the industry average. And I think the big reason for that is team sizes at multifamily offices. There tend to be, instead of one or two advisors, generally whole teams of advisory practices that'll serve $100 million plus clients. So the kind of the staff to client ratio throws their numbers a little out of whack, but I wouldn't think of them as a less productive channel. I think of them as one of the more highly productive channels, but just due to the kind of the way that their firms are often structured, it kind of drags that figure down a little bit.
Is that include asset growth, or is it just new assets coming into the platform?
Yeah, so this is essentially kind of a snapshot in time of year-end assets over year-end number of advisors in the firm. So it does, if there's a big influx of assets on a kind of an organic basis that is not market related over, the course of a year, that would definitely be captured in this kind of figure. If that answers your question, I hope.
Well, if the S&P is up 15 or 20%, your number is also going to be up 15 or 20%.
Yeah, for sure. Yeah, that's a lot of we don't have an exact figure on kind of how, at least one that we can present, although we do kind of pull out organic growth versus market growth. We have data on kind of moderate risk client portfolios, so we're able to sort of model to an extent the amount of growth at a particular firm or channel level that is due to equity markets as opposed to new client acquisitions, but our sizes do definitely capture both.
And correct me if I might be jumping ahead, but do you look at risk profile amongst buckets of either, the advisory group or asset size?
Yeah, to an extent. So we work directly with a lot of advisors and executives across the industry, and we try to get kind of an idea of their product mix as well as a typical client portfolio. We generally don't split by like, a low risk client, a moderate risk client, and a high risk client. We kind of try to focus on sort of their average client, what their most regular client would look like. So we call that a moderate risk. So we don't have too much in terms of, specific risk factors on a channel level. Although it's something we could definitely dig into and get back to it, I think.
No, so the question was more about, do we have data on different ways that these different channels invest in terms of like their asset allocation?
Well, yeah, because I think if the asset allocation, a question that came to me earlier on was, gee, does ultra high net worth have a different risk appetite or aversion of risk than your affluent section, right? And if it does, then in up markets, you're going to see, outsized growth in one. If you have a riskier bucket, it's going to grow a lot more in a good market than it would in, so it's sort of, in the data a little bit.
Yeah, no, and we collect a lot of that data, and overall, I would say it's generally inconclusive, just because there could be, a wirehouse advisor advising younger clients, or a wirehouse advisor advising older clients, or wealthy or less wealthy. The one space that I think we actually have seen that play out is in the trust space for trust companies that are significantly more conservative. And over a certain amount of time, we've seen that play out where their growth is generally more slow in a bull market, to your example, than a more potentially more aggressively invested channel.
Just sort of thinking out loud, I would think that as you go up an asset side, you have better access to alternatives, which might have a higher risk profile, better, so impact the numbers as well.
Yeah, I would say it depends a lot more on the particular client and their kind of personality and obviously their age and asset size than it does on the channel level, which seems like you're more asking about the client type. But yes, obviously younger investors, longer time horizon, more risk on profile, investment profiles, kind of like Chase mentioned on, I think it was the third or fourth slide, is number one objective for high net worth investors is generally wealth preservation as opposed to outright growth. At my time in the family office, we did have clients who were like, hit one, how do I hit 5 billion? So they were really no risk on and wanted to grow it, and they have the ability to do so because they're not at risk of losing their retirement, if you will. But yeah, it's hard to say, kind of like Chase said, inconclusive on a channel level, really like a client personality type. But the alternatives, especially being in the book market, you get a lot more interest in different types of kind of opening investments that change things.
Yeah, I might be getting ahead of it too, but if you looked at number of households that an average advisor would cover across these different sub-channels?
Yeah, we don't publish that, I don't believe, but we do investigate that across kind of our studies of advisors. Generally, the amount of individual clients or client families that they're working with, and it varies widely by channel. So like in the multifamily office, for example, if your asset minimum is 50 or 100 million, an advisor might have 5 to 10 clients. Whereas at a bank, we've heard, especially at the retail bank meeting level, we've spoken to advisors who said they had books of 1,200 people. So it kind of depends on the nature of the service delivery model and the size of your team. If it's a lot more transactional, like you'd see in the broker dealer space, they'll take on a lot more clients. Whereas in the family office or private bank, you could be single digit number of clients that are, ultra wealthy. I'm going to give it back to Chase for a couple slides here to cover the sort of introductory portion of our services and fees, and then we'll get back to some more kind of high net worth specific stuff.
Yeah, so we've talked about the high net worth investor demographic, and we've talked about some of the firms that serve them. And over the last 12 months, one of the major facets of our research in the space has been where those two meet and essentially looking at a lot of the different service dynamics among these high net worth practices. So what we're looking at here, I know there's kind of a lot going on, but essentially we're looking, well, I'd say, so the source of this data is we basically reach out to high net worth practices across the industry and we ask, we give them a list of different services that they might offer to clients and ask, are they offering it to clients? Are they offering it as a primary, a secondary, or outsourcing it, or not offering it at all? And so what we're looking at here is basically we bucket those services and say, how many investment management services on average are high net worth practices offering to their clients as a part of their primary or secondary service offering. And essentially, in all of these different buckets, we've seen a high level of growth. We're not looking at absurd, like 3 to 6 levels of services, but it has been gradual and it has been very consistent. And essentially, it goes back to sort of what Matt was discussing about the different competitive dynamics. You obviously have a significant amount of demand for these services, as we've seen with the asset accumulation that we discussed earlier. And the number of firms competing has increased as well for these end demographic relationships. And so as a result, we've seen firms adding more and more complex type services. So looking actually right to left, what we've seen is, the amount of private banking and trust type services that an average high net worth practice may offer has gone up from 1.4 on average to 2.1. And in the subsequent slides, we'll go through what makes up these individual buckets. But, in planning services and family office services, we've seen that grow as well in the number of types of services that are offered. Investment management services is a little bit more ho-hum in terms of growth. However, there's definitely some trends that are kind of underlying and under the hood that we can talk about in this next slide, actually.
Sorry, what's the,
Yeah, of course.
the left axis?
The left axis is the number of services. So essentially, one way to read this is that, in 2017, the average high net worth practice across the board offered 1 to 2 private banking services, 1.4 on average.
What would be the max?
What would be the max? I think there were 3 in the category. Well, but we'll get to that slide. We'll dig into each of these individually coming up. Any other questions? Clarifying questions?
Is this going to be on the CFA exam next year?
I can't make any promises. I haven't been doing the study, so. Yeah, you might want to pay attention. So if we expand those buckets, and we'll look at first the investment management service offering bucket, this is essentially what we're adding up to what we saw in that previous slide. And we'll make sure the slides are available after as well for all of you to dig into. But I'd say one of the most, where to really start on the slide is with this asset allocation and consolidated reporting. A lot of people in the industry generally consider these table stakes, and the number really hasn't changed. If you go back to 2017, if you go back to 2010, a lot of these firms are going to be offering asset allocation. But what we've seen is that as that has become basically crescendoed at 100%, not all asset allocation is created equal. So the asset allocation you're getting in 2017 even may not be as high quality or in depth or as custom as the asset allocation services you might be receiving today. And so that's what I mean when I say there's a lot underlying the data, is that, an asset allocation can mean something very basic, like setting up a 60-40 portfolio, or it can mean, using SMAs, utilizing direct indexing for different customization services for investing, tax loss harvesting, and all of that would fall under here. So that's why it may seem a little bit more muted in terms of growth of these services. But it is somewhere that firms are actually utilizing, pulling different levers to try and be more competitive and offer a better service offering to their clients. As you look down the line here, alternative manager search and selection, you can see that's gone up as well at a higher rate than some of these other ones. That's been one of, if not the most significant trend that we've seen among investment management type offerings from high net worth practices, is the intense growth in the adoption of alternatives as a sliver of client portfolios. And we have a couple slides later that we'll get into about product strategies. But essentially there's, both obviously supply dynamics allowing more investment into alternative investments as well as demand dynamics with the increasing growth in the population of qualified purchasers, accredited investors, and basically just the purchasing pool has increased substantially. Any questions before we move on to, I think, family officers is what next?
Yeah, I think so. In terms of like a level of difficulty provide, like, does it also follow the order, the board to the right? The, lessons in provide.
I think that's definitely a good way to look at it. It's definitely more difficult to offer, common trust funds or hedge funds than it is like a basic asset allocation service. I would say also somewhat on the opposite side, these services are in just significantly more demand than some of the then offering of a hedge fund or a fund of hedge funds is. So you can look at it in both ways. I think that's also another thing that I didn't mention is, for alternatives, there's obviously been platform development and technology advancements that have helped spur increased ease and lowering the hurdles for getting clients in those investments as well. So that's definitely.
Donor advised funds, do they fall under the common trust fund, or is that something different?
That's a really good question. I
think
don't
they'll
know.
fall under, we have another category for kind of charitable planning, where you have stuff in that, so I think with that, like foundation management and DAsh would fall under
Yeah.
kind of that bucket.
Yeah.
Which actually I think that's a perfect transition point. So here what we kind of look at is outside of investment management, really like the four kind of anchor services for really for anybody, but more specifically for high net worth investors. So obviously financial planning is completely ubiquitous. Everybody is offering it. It's really like kind of the core foundational service of a wealth relationship. The big one, going back to all we've mentioned about and we won't stop talking about in terms of wealth transfer, is the estate planning piece. We have conversations with wealth managers and asset managers all the time, asking how they can tap into the $84 trillion opportunity that's talked about so much. And the big thing is having robust estate planning techniques. By the way, it's worth mentioning. The bars here are services offered primarily or as kind of secondary services internally at firms. So any difference between 100 and the number shown here, they'll be outsourced, which is relatively common practice, and actually can be quite a lucrative kind of structure for advisory practices to have really sophisticated Rolodexes of professional networks with CPAs, estate planning attorneys, even real estate agents. So in the case that one of these services is not offered internally at a particular firm, they're often outsourcing it to kind of a familiar face externally, who they'll work with, and they'll kind of relay referrals back and forth. And like I said, that can be a really lucrative opportunity for both parties, really. But getting back to estate planning, it's something that if basically everybody, if you're gonna, as long as you're not gonna die with nothing, sorry to put it so bluntly, but if you're leaving anything behind, you'd have to have an estate planning practice in place. You don't want your family to have to go through the probate process and go through the courts. It can be a nightmare. So having even a simple estate plan in place for kind of the lower mass affluent or lower high net worth tiers is really critical, especially now with growing wealth in the high net worth tiers. And then, like Chase mentioned, we get into some more complex transfer strategies with QPERTs and GRATs and all of that kind of stuff. Risk management and insurance ticked down a little bit. I think the perception of insurance by both advisors and investors has kind of gone sour, maybe over the last 15 to 20 years. It is a useful tool, and something we talked about yesterday. It's actually a really useful tool for intergenerational relationship building. If you can get the clients on board with having a life insurance policy, they're going to set their kids, either the kids directly or their kids' trust as the beneficiary of that policy, and then you kind of have a built-in relationship with the next generation, which is really the big opportunity here for wealth managers in terms of the wealth transfer is not only maintaining their current sort of what we call G1 relationships through their life, but also having the next generation of advisors at that shop dealing with the kids of previous generations clients. So that can be really kind of a powerful tool from that perspective. And then obviously tax planning, prep and compliance, top of mind for really everybody. There's also some potential changes with estate tax laws that you guys may be familiar with. So since COVID, the lifetime exemption, which is the total number, dollar amount that you can gift throughout your lifetime, on an estate tax-free basis, is right now I want to say it's 13.6 million. It was, I think, 5 to 7 prior to COVID, and it's set to sunset again at the end of 2025. Based on some kind of political risk there, we don't know exactly what the number will be or if it will decrease depending on who's elected, but so the tax money from that perspective is huge because you know, you could be hit with a 30 or 40% estate tax bill at the time of transfer for anything above that lifetime exemption amount.
The states also, you know,
Right.
depending on the states, I mean, Illinois is brutal.
Yeah.
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 Like anything above 4 million can be taxed at like 29%.
Yeah. At the state level. Really? Wow. Are you based out of
My
Illinois?
parents live in Illinois.
Oh, I see.
Mom and Dad, we gotta do something.
Any other questions, comments, concerns on this slide? This is kind of a click down into more really high net worth specific, we call family office services. This is not specific to the family office channel necessarily. We just think of them kind of as like lowercase family office, kind of a way of describing kind of the white glove service model for high and ultra high net worth investors. But they're really taking up across the board. Charitable and philanthropic is a big one that we've talked about. You know, it's a way to say, you know, if you're willing to part with some dollars, obviously there's some tax benefit, although, you know, 100% is more than 30%. So there's some debate to be had there, but people are really interested in giving, and especially younger generations seem to be really keen on donating to the causes that they, you know, that they're passionate about. Bill pay is really the big one, which kind of seems like a simple service to offer. Essentially, when you coordinate payments of all of your clients' bills from their banking accounts, but historically, without kind of the technology that we have now to enable it, it was difficult to implement and it was high risk, and you had to have really like a whole team dedicated to just making payments all the time on a, you know, somebody's car note and their insurance premium and their mortgage and everything. But now with kind of technological enablements for that, it's being offered more and more commonly, and I anticipate when we look at this number next year, it'll go up again. And then foundation.
What would be like an example technology provider?
That's a great question. And you know what? Whenever we do these, I always need to make a note to write down provider names because, like, off the top of my head, I can never think of them, but I'll get back to you with like a specific provider.
Like Cell and those things.
Possibly. I don't know if they offer an automated bill pay necessarily. A lot of the time, like a lot of shops, like at the private banking and wirehouse level, might have kind of their own proprietary system for it. But in terms of third-party license ones, can you think of one off the top of your head?
I can't think of one off the top of my head, but it's not necessarily like Zelle. Like Zelle is more of a B2C type strategy. It's sort of something that usually sits on the back end, and they sell to like family offices to help, you know, improve the just set up like an online portal to make those payments easier and more automatic. But it does go to your point earlier, like this is moving up because it's becoming easier to offer. And yeah, like Matt said, we do have some examples. I can't think of it either off the top of my head.
That's
Quick Google it.
Yeah, a lot of times white label too, like most banks, and I bank with a credit union based in upstate New York, and they have a bill pay service. I have no idea if it's like their proprietary kind of internally built service or if it's a third party provider that they kind of white label and brand under their name, but both options are certainly available and used there. I think that's all I had on this slide, unless there's any more questions. So then moving into the kind of the private banking space. This has been a really effective way to, first of all, increase wallet share with clients if you're able to have a lot of their banking services offered internally. And it really promotes client stickiness. We find that when clients have relationships with kind of multiple segments and service types with a provider, that it's just a lot more operationally difficult to change providers. You know, if you do both your banking and your investing and your estate planning all in one shop, you're just less likely to move, you know, your whole portfolio to another place. So all of these things that you can kind of offer on an internal basis will really help with grabbing client wallet share and keeping it for the long term. And trust admin service, again, that's really the big one. Even though the growth might not be necessarily larger than the other categories here. All sorts of shops are looking for ways to either build an in-house trust company, have trust officers and estate planning attorneys, you know, either through like a third-party referral or, you know, experts in-house. And then all the time we see as well conversations of large wealth managers acquiring, you know, an independent trust company that's registered at the state level and has, advantageous regulatory structures in place for them. Um, so that's a big one here. And then finally in this section, just a quick talk on fees. I won't linger on this for too long, but an industry-wide trend over the last, maybe 10 to 15 years was kind of massive fee compression, where fees just went down and down and down. You had to, reduce your fee structure in order to stay competitive. We've seen them tick back up a little bit. But again, this is kind of a short snapshot in time. So I think as we look forward over the next 3 to 5 years, it'll be really interesting to monitor if they kind of stabilize or if they continue to go up or if they continue to go back down. I don't necessarily have a projection on which way it'll go, but it's kind of a core competitive dynamic, regardless of what channel you're in. But so on the left side, we have the average fee in basis points. This is an advisory fee, so as a percentage of assets under management or, kind of fringe high net worth clientele, it's about 77 basis points. And obviously the more assets you bring on the platform, the better you can negotiate a fee. And then when you get up to kind of the ultra high net worth level, a lot of the time, it won't make sense to charge, 50 basis points on a client who has maybe $1 billion. They'll go with a lot of the time a retainer fee, which basically just says you pay 500 grand a year and, we do whatever you ask. I think even the more interesting part of this is on the right, the fee structures used. So this is the variety of different fee types that they're offering. And again, it's not like a massive, it was 1 5 years ago and now it's 4 different ways. But it is growing steadily. And it just kind of shows that clients are willing to pay for different services, so long as they kind of gain value from those services. So in 2023, we see, on average, 2 or more service structures being used. Obviously, the most common historically are asset-based AUM fees and, commission-based transaction fees. But subscription models have become slightly increasing in popularity. One-off fees for a financial plan are used. I would say that's less high net worth focused. Hourly fees occasionally, like I said, retainers for high net worth and ultra high net worth are pretty commonplace. The performance fee and a couple of the other ones are really not quite as common. But there's all kinds of ways that that shops are willing to work with their clients to kind of charge them a fee structure that makes the most sense for them. And they are doing it in a variety of ways, which is a lot different than the way it was when it was purely transaction and AUM based. Any questions here? Oh, I think not. I'll pass it back to Chase.
So in this final section, we'll go through some different product and distribution trends, and we'll start out with product mix by channel as some of our affluent focused advisor survey research. We're stepping down slightly, so this will be $2 million plus client focused practices, but it still encompasses all of high net worth, but just to increase the samples, we can get it across different dynamics here. I think the first major story in this slide, and something that we've seen over the course of the last 5 to 10 years, is obviously the dominance of mutual funds as the core product type sitting in client portfolios. But the very quick growth of ETFs and the eventual, at least projected, eventual surpassing mutual funds by ETFs, we see that as a certain possibility, and maybe not an eventuality, but probably an eventuality. And so that's one of the main findings here, and you can see the RIAs leading the way. So getting back to the idea of a more independent-minded advisor is usually going to be leading the way in terms of some of these new, more client-focused product choices. So you see independent RIAs using ETFs already more than any other product type. Another main theme we see here is the use of separate accounts and the growing use of SMAs and UMAs at wirehouses and banks. Over the past, people have been talking about the adoption and movement to UMAs for a long time, but separate accounts themselves, the use of direct indexing as well more recently, has really become the most scalable and really strategy of choice for centralized investment decision making in organizations like wirehouses and large banks. And so that's generally probably the second biggest trend that we've seen in product choices among affluent and high net worth focused investors. The third one being alternatives, and you don't see it as much here because we are looking at $2 million plus end investors, but you see wirehouses leading, and I sort of mentioned it earlier. Wirehouses are utilizing and leaning on platforms like Case and I Capital more, probably more than most other channels. And so those lower barriers with more education and less paperwork generally allow higher adoption of alternatives at wirehouses. But if we go to the next slide, you could see over the last few years, this is the adoption of alternatives from our proprietary survey of high net worth practices. In the dark bar represents all high net worth practices surveyed, and the light blue bar represents multifamily offices surveyed. And this is their adoption or their allocation to alternatives for their moderate risk investor. So their average investor in their practice is going to be allocated roughly to this degree. And so we saw overall affluent focused practices allocating around 1, 2, 3%. And when you look at the highest level of wirehouses for affluent focused investors, you see like 5 or 6%. Overall in the high net worth space, we see allocations up to 9% now. And when you look at the ultra high net worth, clients with 20, 30, 40, 50 plus $1 million, you see a lot of a significant higher adoption and use of alternatives in their client portfolios as well. And so we've discussed a couple of reasons for that. There's obviously been supply side factors with alternative shops generally seeing a slowing adoption among their institutional clients, while simultaneously seeing a massive surge in the creation of private wealth in the retail space. And so those shops have done their best, and there's been a couple that have done it really well, to pivot their distribution and product manufacturing strategies to focus on that retail space and the high net worth and ultra high net worth space. And so they're meeting that client demand with adequate supply. And when increased demand and increased supply meet, this is when you see really high growth in the alternative space. If we go to the next slide, we can kind of dig down into that demand side and the mindset of high net worth advisors as they do adopt these strategies. And first and foremost, you see growth or enhanced return opportunity as the number one driver of client adoption at high net worth practices for alternatives. This makes sense. It makes sense for either a client first getting in or an advisor recommending a client first get into alternatives. Is the potential for growth. Private equity returns that you can see even on average have been higher than a general corollary in the public market. And then you obviously have things like venture capital and other things that, the numbers get, when you look at the top quartile, at least numbers get significantly higher than public options. And, you look down the line, portfolio diversification is another thing. You see a lot of public companies that are choosing to stay private because the ecosystem of financial support, whether it be through equity or debt financing, is significantly more complex and allows them to stay successfully private for longer. And so the options for investing in public markets have dwindled as a percentage of overall investments. So to get outside of the public sphere into private equity, into private debt, private credit, and other things increases portfolio allocation or portfolio diversification, as well as things like venture capital and hedge funds and other different types of funds with non-correlated strategies, things like commodities and pretty much everything you can think of in terms of an investment strategy can offer potential diversification outside of public markets. Any questions on here before we move past alternatives?
Just to clarify, this is non-liquid alternatives.
Correct. This is non-liquid. So these are not in, mutual fund wrappers. These are not, liquid alts. No, these are your private equity, private debt, private credit, things like that.
This is a snapshot of 2023.
Yep. Yeah, so this is a survey of high net worth practices in 2023.
How do you think about the forecast, like the future?
Of alternatives in general, or what motivates clients to invest in alternatives? I would say that you might see portfolio diversification pull back slightly. For the better part of this century, there's been a strong correlation between, both sides of the 60/40 portfolio. But we've seen that sort of dislocate. So there are more options for portfolio diversification in public markets. So I might see portfolio diversification be less of a selling point looking forward as we're in sort of a normal interest rate environment. We've got one more slide. It's just getting into some of the dynamics between asset managers and their relationship when they're interacting with wealth managers in terms of the selling points around their products. And I think it's just interesting. We asked both asset managers and distribution executives, sales professionals at asset managers, what are the most important factors when they're going to wealth managers who are conducting due diligence for new products. We also asked high net worth practices what they consider most important. And you can see overall, they're somewhat aligned with process, performance, and price being three sort of pillars that stand up the relationship. But at the same time, there are notable disconnects where you have asset managers thinking, or under the impression at least, that performance and fees and even things like brand and reputation make more of a difference than they really do in the eyes of wealth managers. Whereas for wealth managers, things like philosophy and process, risk controls, style consistency, and more of those, less apparent but very important metrics are slightly more important to the wealth management practices. So that's just something we like to discuss a little bit for obviously significant stakeholders in the asset management industry. Any questions on anything we've discussed so far? Pretty much have a wrap-up slide here, and then we can take questions. But we've gone through some of the demographic changes, the intense growth of wealth in the private or in the retail market, and how that wealth has been concentrated into the high net worth market specifically among the wealthiest 2% of households, essentially now controlling over half of the addressable market for financial services. We talked about the different changes in market share and how firms are competing for these end investors and which services they're using to compete, grow their market share and attract new investors and grow relationships. And we discussed alternatives, the growth of alternatives, the importance of separately managed accounts, ETFs, and some of the distribution dynamics between asset managers and wealth managers. That's all we have for today. Appreciate everyone for taking the time. Appreciate the CFA for having us in. Yeah, if anybody has any questions, feel free to ask.
Could you go back to that last slide?
Yep, the summary slide here.
Yeah, because it's sort of, I was thinking this when you started, that growth from 27, the first bullet, greater than 5 million, the growth from 27% to 51%. Is that returns adjusted at all? So for example, in the last 13 years, if you had $2.5 million and you grew it by 10% or whatever every year, you get to that 5 million mark. So is there any adjustment for that type of growth?
So there isn't an adjustment for returns like that. So it's data we get from the Fed where we essentially pull it down as it is and compare it over the past years. But you can see, obviously, doubling is very significant in terms of market share for those households, and it is significantly above. It's significantly above inflation in terms of the rate of market share growth. It's not necessarily above market share because wealthy households hold a significant majority of the investable assets and significant more exposed to capital markets. So that's a dynamic we don't necessarily want to pull back from and showing.
But it would be sort of skewed by that impact, wouldn't it?
Yeah.
As long as they don't spend it.
Yeah.
Going back to the different channels that you have with banks and privates, whatever, do you see, you guys look at what their strategies are for getting high net worth clients? Is that a consistent? Okay, I know that obviously ones that are affiliated with banks would have that kind of normal, but it does just curious, like how are these guys attracting new clients?
Yeah, so I think that the main point that I would say is just the growth in services and providing a more comprehensive ecosystem of professionals around the client in the high net worth space particularly. So instead of just having, a one-to-one relationship where the advisor sort of goes through people on the back end, you have to surround the client with, their estate planner, their portfolio manager, the, pretty much around the line, private banker, things like that. That's an evolution in service strategy that we didn't necessarily touch on, but it helps sort of provide more color to the conversation around increasing services. Honestly, I think advisor movement and attracting very high performing advisors and teams and even small firms at times that have shown a high propensity to serve and attract investors in the high net worth space is honestly, when you look at some of these large firms, the strategy that they're looking into potentially even more than attracting the end investors themselves is to attract the advisors that are good at attracting them.
It's like they have a hard time pulling people out of wirehouses because they don't own the book, the wirehouse owns the book, right? So.
It depends. I mean, there's a lot of movement between some of these different channels, but overall, on a net basis, we see wirehouse advisors, private bank advisors moving towards that independent model. And there's a lot of independent RIAs, RIA consolidated firms that are doing a good job at making their firms very fertile ground to bring in those teams so that they can perform as good, if not better than they did at the wirehouses, while increasing their ability to monetize their practice and have slightly more discretion over how they serve their clients.
Yeah, to your point, some of those channels where the assets are, if you have kind of services offered through multiple arms of the business, to your point on, wirehouses and banks kind of owning the books, the assets are definitely sticky, but clients aren't still locked in necessarily if they're, if they have a good relationship with the advisor first, and they want to go to an independent affiliation model where instead of getting paid out, 50 basis points, they can get paid out 85. A lot of the time they can bring, maybe even 80% of their existing client asset book with them. So, I think to Chase's point, the advisor group, there's a certain point when, services across the board really become ubiquitous, and it's all about how many of the best advisors you can bring in, and how good of relationships they can develop with, with their clients. And for the firm, it's kind of advantageous to sort of spread out, spread the love a little bit about who's serving those clients, so it's a little harder for them to, kind of move channels as the advisor goes. We can also, for people taking pictures of the slides, we can send the deck send one over to Mackenzie, and we can have that distributed if you guys want to copy it. Yeah.
Matt, could you spell out the product mix?
There you go.
I want to make sure I got this right. So it looked like independent RA is very low on separate accounts, but wirehouse is very high. Given what you just said about the movements and going to that channel, would we expect an increase there, or does the wrapper not matter that much? Are they indifferent between the ETF and the separate account? Given kind of the tax considerations, I would think tax loss harvesting would be something they want, but it just seems very dramatic numbers.
Yeah, and that, I think one of the main selling points for building sort of an investment offering around separate accounts for wirehouses, and the data isn't here, but private banks are also heavily into that space, is just the ability to scale it significantly and have a centralized level of control over the investment decisions and the product choices, which somewhat is the antithesis of what an independent RIA is trying to represent. However, I would say as the RIA industry becomes more consolidated and the custodians and consolidator firms build out somewhat comparable ecosystems of product support, I think that you'll see this number tick up for independent RIAs as that part of the industry builds up and sort of pivots from the internal side of wirehouses and private banks to more of a third-party model with independent RIAs.
Thank you.
So the due diligence priority.
Yep.
Comparing asset management. Distributions, like a philosophy of the process. What does it mean? Is that like whoever doing the due diligence or the principle behind?
It's basically, I would say it represents the strategy, the investment strategy. So, you know, our goal, the goal of this fund is to invest in X, Y, Z, and this is our index, and the ability to stick to that index is sort of encompassed in philosophy and
Like
process.
that's expressed by preference by.
The investment policy statement, the documents, and the PMs who are running it.
I mean, like for whoever's like selecting the products, like are they inserting their own preference for the philosophy and the process, or are they reflecting whatever the principles want? If I'm making myself clear.
I think actually at the advisor level,
So advisors.
I think so that I would say it depends on a couple of factors. One, type of firm that you're operating at. A lot of them will have centralized kind of product buying processes where they'll have a recommended list of available products. And then there's other firms that have more open architecture, where the advisor's kind of free to work directly with asset managers. And if a client said, you know, for example, I see a Global X sign back there, I know that they have a lot of really interesting funds like an aging population fund and some other stuff that are kind of unique exposures. Whereas if a client's interested in that kind of thing and the advisor has the latitude to work directly with an AM, they may do that to kind of fit the preferences of, you know, of that client type. Another example that we kind of see when it comes to kind of philosophy and process, which isn't necessarily covered here, is the concept of ESG and SRI investments. That's become really politicized, and we hear some advisors saying they don't want anything to do with it, and others saying that, you know, they want to funnel as much, you know, of their clients investing into ESG as they can. So I hope that answers your question. I think that was what you're asking.
Yes, that's very helpful. And performance, it's a little bit surprising to see that it's only 50%. Like how to interpret this 50% of the distributors are emphasizing performance versus the other half they don't care.
So I'd say the way to read that is that, so for high net worth practices that we surveyed, I think they get to select their either top 3 or top 5 most important factors when conducting due diligence or new products. So 50% selected performance as one of those. So it is low, and asset managers would agree with you that it is low. But I would just say that, you know, a lot of these more complex high net worth type practices, they're really looking for a strategy that fits into their clients' needs. And it's not necessarily we're just going to cherry pick all the highest performing, you know, 10-year CAGRs. We want something that fits into our clients' you know, fixed income sleeve. We want something that fits into our clients', you know, small cap strategy. And so we're looking more into the philosophy and process that goes into the, you know, potential fund managers, you know, fixed income sleeve rather than their historical performance. So we want to know that they're going to be able to stick to those investments and stick to that methodology, because that's going to play into all of the other investments in our client's portfolio.
Plus, you're seeing that on the equity side, the move from active to passive, right? So the performance really would matter.
Yeah, that's definitely an aspect to this as well.
Whatever, you know, so the past performance is not indicative of future performance.
That's true.
That's what they say.
When asset managers think it's important, like that's all they do, right? They're always like, let's beat the benchmark, right? That's
Yeah.
I'm curious, do you have more data, like historical data? It's not just like into 2023, maybe you have data for the past 5 years. I don't know if you track this data, that the picture would be different.
That's a good question. Off the top of my head, I don't think there's been any significant moves in this. You know, we see, you know, process, performance, and price generally being the top 3, and some of the other numbers fluctuate. Thank you. More around where they are. And I wouldn't say that I am aware of at least any significant fluctuations over time with how this is developed.
Yeah, I agree with Chase's sentiment there. Not much of a big change, but if we can look into it and see if there were any staggering changes and get back to you guys.
Thanks, guys.
That's our time. Thank you for having us.
Happy to help. Yeah. Thank you.